Now, see, one thing before we do anything is classifying the lease, right? Because the entire accounting will depend upon how is the lessee. So how is Anirban going to classify the lease in his books? And how is Tesla going to classify the lease in its books, right? Now, both of them are different and both of them have different parameters of choosing the lease. Now, first look from the lessee's perspective, right? So in my example, if Anirban was to get a car from Tesla, under what situation is he going to categorize the lease differently? Why is this classification important? Because depending on the classification only, we are going to choose what will be the accounting that Anirban is going to choose for this car. Okay, so first thing is understand that, and we'll see how in Tesla all the three levels of accounting is applicable as a lessee as well as a lessor. See, so first thing to tell you is very simple. If you are a lessee, you have a choice to know whether you're talking about something which is short-term lease, extremely short-term lease. Now, I'll give you an example. In India, whenever we take a flat on rent, in India, the law says that whenever I take a flat on rent, it should be not more than a year. So typically, we get into 11 months contract with our landlords, which is renewable after the tenure of 11 months. And that is up to the landlord and the tenant how they want to renew the contract. If it is a contract like that, which is less than 12 months in tenure, then US GAAP gives an option to all the lessees. That's see, you don't get into the jamila of leasing. You just treat it like a normal rental contract, right? And the lessee has an option to choose. So if let's say Orgo and Joseph here, right? Orgo is a lessor. He has a flat and Joseph goes to rent that flat from him. Okay, so let's just say that Joseph goes on a work to Calcutta. Orgo is a Calcutta resident. He has a flat. Joseph goes and tries to take that flat on rent, and it's an 11 months contract. So what we're talking from Joseph's perspective. For Joseph, US GAAP gives you a very clear choice. It says that if it's a short-term contract, less than or equal to 12 months, and if the lessee wants, he can choose that contract to be treated as highly short-term leases. Now, if you do that, then I'm not going to even classify it like a lease contract. I'm going to treat it like a regular rental contract. Joseph, as a tenant, is going to pay monthly rents. So he will simply say rent payments account debit, and he will credit bank. And Orgo is a recipient of that rent. He will simply say cash, and he will write rental income. That's it. I am not going to even cover it under the leasing standard. I'm going to call it a regular rental contract, where one party, in my example, Orgo, who was a lessor, he will just book the rental income, and Joseph is going to book the rental payments. Now, do you realize that this does not go and impact your balance sheet at all? Because it's just a P&L expense and a P&L income, right? That's it. For the lessor, it becomes an income. When for the lessee, it becomes an expense. So we are not going to even treat it like a leasing contract. So out of leasing context, you treat it like a regular rental contract and you book it accordingly. But then we have a next situation. What if a contract was not a 12 months contract, right? What if the contract was not a 12 months contract, or even if it was a 12 months contract or lesser than that, the lessee is not choosing to treat it like a regular rental contract. So now you say, okay, now we have to go to the leasing standard and say, how should you be accounting for that contract? So we say, okay, then we ask ourselves, there are 5 different criteria that US GAAP has listed for a leasing transaction. Have you met any of those criteria? We'll discuss what these criteria are. But if any one of those criteria are also met, then the lessee will classify that lease as a finance lease. Now, see, in a lot of books, like Becker, they have called it like a finance capital lease. It's the same thing. It's a finance lease, and you're going to classify it as a finance lease. And if none of those criteria are met, then the lessee is going to call it an operating lease. That means for a lessee, there are 3 classifications that's possible. Either you're going to take it outside the purview of a normal lease agreement. You're going to call it a rental contract, treat it like a rental expense and a rental income in 2 different parties' books. Else, see whether any of the 5 criteria that US GAAP has listed is met. Even if one of them are met, I'm going to call it a finance lease, else I'm going to classify it as an operating lease. Now we'll see what these criteria are, but what is the biggest delta between the two? If it is a finance or an operating lease, I'm going to capitalize an asset in the books of the lessee. And we are going to call that asset a right of use asset. And I'm going to bring in a liability called a lease liability in the lessee's book. So if it is a finance or an operating lease, we are not going to let the balance sheet be silent. We are going to ask you to bring an asset in the books of the lessee, call it an ROU asset, right of use asset, and we'll ask them to create a long-term liability in your books or a short-term liability. We'll see how that works, which will be terming as lease liability. Okay, so before we go further, I want you to first understand what these 5 elements are. Okay, look at these 5 elements. One second. See, so what I tell you is, see, the idea is this. In my example, if Tesla gives a car on lease and a new car with 6 years, see, that car is being given for a very, very long time. That's number one. So we say, okay, there are 5 conditions. If any one of those conditions are met, I'm going to call it a finance type lease. And if, let's say in my example, if Anirban does qualify any of those 5 criteria, we will ask Anirban to capitalize that asset in his balance sheet and then depreciate that asset. Okay, so what are those 5 criteria? First criteria is it's a specialized asset. STOPS. We have 5 criteria. So first is it's a very, very specialized asset for which after the asset will be given back to Tesla will have no use of that asset. So something like, I know a lady who started something called a book van in the Gurgaon area. So what she did, she took a big van, trailer kind of a thing, and then she converted the entire interior like a library, and she painted the outside of the van. Now, once, let's say that van was on lease, and if that van was now given back to the vendor, Mahindra truck, I think this is what she got, then in that case, Mahindra will have no use because you cannot go and resell that truck to anybody else. So when I'm talking about a specialized asset, the moment that asset goes back to the lessor and the lessor loses its value because it's not tradable, it has become a unique asset, then we have to think about that asset as meeting one of the criteria. That means the moment that specialized asset is given by the lessor to the lessee, immediately I'm going to treat it as if that asset is the lessee's asset, even though the lessee has to give back the asset to the lessor. But since that value back is nearly nil to the lessor, I'm going to treat as if that asset has now been sold by the lessor to the lessee. And the lessee will record that asset as a right to use asset in his books, right? So that's the first criteria. Second criteria is, now see, these 2 criteria typically means that even now, when the lessee is using that property, it is as good as his own property. We don't have to wait for the end of the lease term to recognize that asset. How? If, let's say, 2 parties, okay? So we have a lessor and we have a lessee. If both of them enters into a contract and the contract says that you use the asset for 5 years, and after 5 years, that asset will belong to the lessee. And we say, boss, even now that asset belongs to me. Why should I treat and wait the 5 years tenure to end? Even now that I'm going to account for it, I'm going to account for it as my asset. Why? Because the asset is anyway is going to get transferred to me at the end of the lease term, right? So when the title, the ownership transfer is effected at the end of the lease term, it is as good as lessee owning that property even now. So it's just a financing arrangement which helps you to pay in installments. So we will recognize an interest expense and an interest income. That's okay. But the asset now belongs to the lessee and not the lessor, right? So we say if the title transfer happens at the end of the lease term, even when the lease is entered into, you're going to think that means that asset belongs to the lessee right now. This one we've already covered. If the lessee has an option to purchase the leased asset at the end of the term, which is the case in Tesla, right? So if you look at it, Tesla gives 6 years or 72 months cars on lease to its purchasers. They already have So they don't have an option to purchase, unfortunately, but it is 1 second. Yeah. So if they come up with an option to purchase back the asset at a particular predetermined price, I'm going to even today treat it like a asset that belongs to the lessee and not to the lessor. Right. So in case if the lessee has a right to purchase, so typically this works in all the machines, guys, big heavy machines. Let's say if Siemens is taking a machine like that from some other party, and if that machine is going to come up with an option that at the end of, let's say, 9 years or 10 years, that machine will now belong to the lessee. The lessee will have a option of purchasing that asset. That itself becomes like a leased asset to the lessee today. So the lessee, in both the cases, the lessee will debit an ROU asset and will credit a lease liability. That means treat it like a lessee's property right now when the asset is given to you. Don't wait for the lease term to end. So 3 things: specialized asset. Remember the example of the book club that I was talking about, the mobile book van, okay, or the book library. Title transfer, the title is transferring at the end of the lease term, or if the lessee has the option to purchase the lease asset. We call it written bargain purchase option. So technically, this is termed as written bargain purchase option, and the lessee is always supposed to exercise this unless and until for your practical purposes it is given to you, the lessee will not exercise this option. Now see, this means the value that the lessor is getting is so much even now that it means it's as good as just selling that asset to the lessee, rather than, you can camouflage the transaction anyway, but if what the lessor is receiving right now is equal to or greater than 90% of the value. 1 second. Yeah, Anita, just give me a moment. Let me finish this. I'll take your question, okay? So if the value that the lessor is getting is so much that it's covering the entire value of the leased asset, then we say that's as good as a sale of the entire leased asset from the lessor to the lessee. So what is that value? We say, okay, take the PV of what? Leased payments. Everything that the lessor is going to get from the lessee. From the lessee, remember, we're not going to take a third party here. We are going to take the entire value that the lessee is guaranteeing to the lessor, either the monthly payments or the guaranteed value. Take all of that up and then compare it with the fair value of the leased asset. If what the lessor is getting today is greater than or equal to 90% of the value of the leased asset, today's date, and I say it's practically the sale of the asset from the lessee to the lessor. It's as good as selling that asset. So the lessor will just remove the asset from the books. The lessee will bring the asset in its book. We'll see how this works out, guys. We're going to see the questions on this, right? But right now, I just want you to understand that the concept of lease says that you're using the asset so much from the lessee, from the lessor to the lessee, and the lessee is giving you so much money that it is as good as selling that asset right now. So you might call it a leasing arrangement, but it's actually a sale arrangement with the leasing concept built into it. So the lessor will de-recognize the asset and the lessee will recognize the asset in this books. So what do we say? Everything that the lessor, bring everything to today's day. What is the fair value of the asset? Take 90% of that and see whether what the lessee is guaranteeing you today and paying you in form of lease rentals or the guaranteed value. If that exceeds 90% of the fair value today, then you're getting so much value from the leasing transaction that it is as good as a sale transaction for the lessor. And then is the tenure. The tenure is so long. That means you're giving the lessee the right to use the asset for so long. That means it is as good as selling the asset, because you're not going to use anywhere, get any value back when the lessee gives that property to you, right? So what they say, technically, the standard is not given it, but there were guidance that came later. And US GAAP says that if the lease term is greater than or equal to 75% of the remaining useful life of the asset, that means more than 3/4 of the value of the entire asset's life, you're letting the lessee use it. It's as good as selling the asset, right? So what do we say? 5 topics. STOPS. Specialized asset. Title is getting transferred. There's an option for the lessee to purchase the asset. So both these cases, if you look at it, guys, both these cases, basically the lessee is the owner right now. Right now itself, the transaction is camouflaged in such a way, but if you look at the substance behind the form, you would know that the lessee is practically owning that asset right now. And the other two conditions are the lessee is owning the asset, the using the asset so much and giving you so much value out of those assets that it is as good as the lessor selling the asset to the lessee, even though you call it like a lease transaction. So if any of those five conditions are met, specialized asset, title is getting transferred, the lessee has the right to and the option to purchase back the asset at the end of the lease term. The lessee is paying so much money to the lessor over the entire tenure of the lease that if I bring the PV of that and I compare it with the fair value of the asset, the PV of all the receivables that the lessor has from the lessee is greater than or equal to 90% of the fair value of the asset right now. Or the tenure of the lease, the number of periods for which the lessee is using that asset is more than 3/4 of the value of the tenure of the full asset. Then we say that it's as good as selling the asset from the lessor to the lessee. So if I go back to my example here, guys, right? So what did we say? We said that, one second, yeah. We said that if you are a lessee, if that contract is for less than 12 months, you can have a choice to treat it like a rental contract. Forget about leasing. But if you do not choose that, or if the contract is for more than 12 months, and if any of those four criteria are met, specialized asset, title transfer, option to repurchase the asset at the end of the lease term, the PV of the lease rentals to be received by the lessor so much that it is equal to, that means it is equal to or greater than 90% of the fair value of the asset, or the asset's tenure that has been leased to the lessee is greater than or equal to 75% of the expected life of the asset. Then I'm going to treat it like a finance lease in the lessee's books. And if none of these criteria are met, I'm going to treat it like an operating lease in the lessee's book. Now, earlier, guys, before the standard was, yes, Rahul, any one of these, either S or T or O or P or S, any of them. Anita has a question. In case of 12 months contract, if contract is renewable and tenant reviews it every year for 5 years. Okay, Anita, to answer your question, if it is less than 12 months, but if you're reasonably certain to exercise that option, you're not going to call it a regular rental contract. You're going to treat it like a normal contract, a leasing contract. Have I answered your question, Anita?
Sure. If the contract for 11 months, not 12 months, then and it's renewable.
Yeah, you see, if it is renewable and if you're 100% sure that you're going to renew the contract, then you're not going to treat it like a regular rental contract. But if it is a scenario where the industry practice is such that the lessor may refuse you, then you're going to treat it like a regular rental contract. See, in the US, contracts, I think, are not entered into for such small terms as we have it in India. For them, the contracts are easily 2 years, 3 years, it's like that, right? But general rule they tell is, if it is something that can be renegotiated every 11 months and the lessor has the right to tell you no, which is a very common practice, then only you can treat it like a regular rental contract, not otherwise.
Okay.
Is this clear?
And the other question I have is the option to exercise, like they have given you a bargain purchase option. So that will be favorable to the lessee, then only he will exercise, right?
No, not necessary. See, in a practical scenario, if that option is given to you, you will always assume that the lessor will force you to exercise that option, because that is how the contracts are always termed. Unless and until they tell you specifically in the question that the lessee is not reasonably likely to exercise the contract, then only you will assume that the bargain purchase option will not be taken. You will assume that it is always favorable to the lessor and the lessor has the right to force you to exercise that option. Have I made myself clear?
I thought it's the other way around. It should be
No, it isn't.
lessee.
No, it isn't. So even though they call it a bargain, actually it is not a bargain. The presence of a purchase option implies that the lessor will force you to honor it.
Okay.
Clear? Unless and until it is given to you. If it is only given that the bargain purchase option is there, you will always assume that the lessor will force you to honor it. Okay. But if they tell you specifically in the question that the lessee is not likely to exercise it, then only you will treat as if it is not existing.
Okay.
Clear?
Okay, yeah, thank you.
Yeah. Rahul, have I answered your question? Anyone, if S or T or O or P or S, if any of them are applicable, you're going to treat it like a finance lease from the lessee's perspective. If none of them are applicable, then you're going to treat it like an operating lease. Okay. Now, guys, I'll tell you just one thing. What used to happen earlier was, in case if it was an operating contract, we never used to allow the ROU asset to come to your books. We just used to treat it like a, so this is what used to happen earlier. The operating contracts in the lessee's book used to be accounted for like a regular rental contract. We will just pay rents. So now understand what Anita was saying, right? If you have a renewable contract, every 11 months you're renewing. So what companies were doing, they were buying, they were leasing huge assets. So even today, when you go, I'll show you the Tesla's balance sheet in the end. You will see how they are having so much of, the gigafactories that Tesla is building up in Shanghai. They have a gigafactory. In Nevada, they're having a gigafactory. All of these are leased properties. So what was happening earlier? The people, the companies were camouflaging their assets like this. At one end, they are not having any balance sheet impact. Can you see that? I'm bringing the asset in my books, but I'm not recording it as an asset. Why? Because it's a lease transaction. And I used to camouflage the transactions in such a way that I'm going to treat it like a normal renewable lease contract. And I used to just have P&L impact and no balance sheet impact. So we used to call it off-balance sheet financing. You're using the assets, but you're not showing it as the asset. So what would happen? The ratios would improve, right? Your returns are same, but your assets are going to go down. You're not bringing the assets into the picture. Right? So your returns on investments and the return on capital, all of that used to be better. Why? Because the asset base never used to reflect those assets. So imagine if we would allow this to happen to Tesla right now. So these huge gigafactories that are on lease contracts will not feature anywhere in your balance sheet, right? And that is why the US GAAP came and said, no, either you can't treat it like a regular rental contract if the tenure is less than 12 months. Otherwise, whether the finance criteria is met or not met, either of the two, I am going to ask you to capitalize that asset and to book a liability in your books, which should feature a long-term asset and a long-term liability in your books. And I will force you to depreciate that asset. Right? So now this is the biggest delta between what used to happen earlier and now. In case of operating contracts, you can no longer treat it like an off-balance sheet item. I will force you to record a right of use asset and book a long-term liability in your books, even if it is a operating lease. And you will see how this works. Till now, anybody, any more questions? Anybody, any more questions?